President Trump increasing tariffs on Canadian steel and aluminum imports to 50%. Joining us now with his reaction is Citi Global Head of Commodities, Max Layton. Max, great day to have you here. What is your immediate reaction to this news?
Sure. I think, thanks for having me on. I think the 25% tariff that Trump had on steel when he was inaugurated, the 10% tariff on aluminium, he's obviously raised them. That's been all about bringing back the industry to the U.S. and securing a domestic supply chain for these key metals, steel, aluminium. He's adding copper to that list. He's talked about doing a 25% tariff on copper. So I think that was the initial premise. This latest increase in tariff seems to be in response to the negotiations around border security and fentanyl, the response of Canada to that, putting export tariffs, and then, steel and aluminium have now been caught up in that. So look, that's the early read. We're certainly of the view that the steel, aluminium, and in the future, the likely copper tariffs will be sticky. And in fact, one of our top trade recommendations that we have out there at the moment is for our clients to be long COMEX copper against short LME copper on the December contract. And we're expecting that tariff to be at least 25% in line with what Trump's talking about.
At 50%, though, does that change the demand equation for steel and aluminum?
Most likely. I think there's a window here between when Trump has said today that he puts in place these tariffs. He said he's going to do it tomorrow. There's a window of a couple of weeks between now and early April when we're likely to have more calibrated, broader tariff policies announced. And so I look forward to seeing those details.
Max, at the same time, on the energy side, I'm trying to keep track of the latest version of events here, but it seems as if there was going to be perhaps some allowances for Canadian crude oil imports, maybe not as tariffed as heavily. And just how does that filter into where we are in terms of supply-demand balance in crude oil at the same time OPEC talking about producing more?
Sure. Yeah, I mean, I think we approach this from the broader context, which is that, Trump is, the president of a near $30 trillion economy. And, given the cost of living issues, the high interest rates, the, higher than targeted inflation, Trump has shown that he wants, he needs, and he's likely to persist in using all the tools at his disposal to deliver lower energy prices, specifically oil and over time electricity prices is where he's focused and where the administration's focused. And, I think that makes a lot of sense in terms of the scale of the potential impact. We've done a lot of work looking at what $60 Brent would mean in terms of a deflationary impulse for the U.S. economy. And you're talking about $150 billion, well over 0.5% of GDP deflationary impulse coming from those kinds of oil prices. So we're not expecting, material tariffs on energy imports into the U.S. from Canada as the baseline view. It just wouldn't be consistent with the broader drive and push and need and rush for lower energy prices that Trump's been really, put at the forefront of his policy agenda.
Max, administration's been pretty clear. They think production doesn't suffer even if you got down to, say, 50. Do you think that's true? You think producers would still find value in production even at those levels?
So he's already talked about tax cuts for the energy industry. That has kind of surfaced. And, we'd been flagging that for a number of months, that it was likely that something would come on that front. We haven't seen the details of it. But it could be, for example, tacked onto the broader package. We were really surprised by how small the numbers are relative to the scale of the U.S. economy, relative to the scale of Trump's other commitments in terms of tax cuts extensions. Total capex for the oil and gas industry is around $100 billion. You could really support domestic production via tax cuts or subsidies or other innovative policies. For only around $15 to $20 billion, you could really move the needle on that front. So I think it's plausible that production holds up even at lower prices, but only if you get that subsidy or tax cut.
Really, really good context there. Thank you for breaking down the math. Max Layton, appreciate it.